Thank you, Rebekah, for joining in again today. I like checking in with you because you really do have a pulse of what is trending with condos and their associations and just, the new and up and coming things. And I think it's really helpful for buyers and homeowners of all types who are condo owners or looking to kind of be in the know, because everything does change and every building's different and there's all these different factors that go into it. And you are really the only person I know that really can dissect it in a way that is approachable and that a lot of people can understand from how you've kind of attacked it. So I always appreciate your insights and our little gossip sessions and all that sort of thing too. So thank you.
Well, thank you for having me. Same.
The way we're going to attack today is just to kind of have a discussion about some topics that you're seeing, trends, and just different things. And so why don't we just kind of go ahead and start with, what are you seeing right now for condominiums specifically in maybe the financial realm? There's been a lot of kind of hubbub about increased costs for homeowners associations, and we kind of know what a few of those are, but why don't you kind of dive into that first?
Yeah, perfect. I see that specifically quite a bit, of course, and it's exacerbated by post-COVID. So prior to COVID, and between the subprime mortgage condo market collapse and COVID, we tended to see kind of an average of 3 to 5% increase annually in the cost for associations to do business. So their operating expenses, which is basically the association's dues per unit. It was kind of a 3 to 5% increase, pretty standard for quite a while. We hit COVID. Lots of associations did a 0% increase in assessments because of all of the impact and the hardship that COVID brought. Post-COVID, I'm now seeing 8, 10, 20, 30% increases in 1 to 2 years because of all those factors. So part of it is catch up from not increasing during COVID. The other impact coming out of COVID is that inflation. So the need to increase the reserve contribution portion of the budget has gone up 20, 30%. Generally, that's a big portion of a condo's budget is the amount they put away to reserves. So if 20 to 30% of your budget has a significant increase, that's going to transfer out to your overall increase. In addition to the reserve contribution related to inflation, we have insurance, which is going up astronomically for many associations. I did a review recently for a property that's on piers, and we have water around here. We have properties on piers around the lake. Their insurance cost was roughly $44,000-ish in 2021. It went to over $220,000 in 2024. So part of that is a little bit of deferred maintenance, but that's also a fairly standard reflection of the market. If an association or a community has already some unique risk factor, it's now just incrementally more expensive to insure it. The standard rate of increase for everybody's gone up. If you're unique, it goes up even more. So I would say, I think I pulled out of 100 that I've looked at so far in Q1 of 2024, I think the median increase in assessments in a 5-year period is over 30%.
Wow. Yep.
So, go ahead.
Also, I think for personal homeowners, condo owners, a lot of the shifting of the policies of how they're actually doing the insurance claims within the building has changed too dramatically. I'm now hearing stories because, in condos, water events are like the number one thing, right? And now I'm actually hearing that because the changing in the policies of the HOA of who's covering what when there are these water events, the homeowners have to use their homeowners insurance to actually cover these damages. They're actually not being offered renewals at this point for a lot of and these are towers downtown that should not be having this issue. So I think actually the play on insurance is going to have to change in future years, because that's going to, if no homeowners can get insured or renew their insurance, because let's say they had a couple water leaks that weren't even attributed to themselves.
Not even their fault, right?
Not even their fault. So what's going to happen there, right?
I think we're going to see, as a result of the condo insurance market going up astronomically, you're exactly right. The association's only option is to push more cost and burden down to the individual owners through their individual policies. And the associations that aren't doing that are suffering. They are struggling because they're paying every claim that shows up. They're responsible for until they, unless it's, of course, negligence. That's kind of the one differentiator. If it's not something that somebody intentionally or unintentionally but was responsible for, so negligence, if it wasn't something like that, historically the association paid all the costs, all the claim, all the responsibility, even repairing interiors to some extent. So yeah, the push to remove the association as much as possible from damage and repairs is absolutely happening because it's the only way to stay in business, essentially. So yes, homeowners are taking on a significant more obligation and responsibility and cost profile. Absolutely.
Yeah. And a lot of that does trickle down for the condo associations that have not modified how that structure works. It's trickling down into special assessments too.
Absolutely. If you have a $50,000 problem one year and your budget's 500, I mean, that's 10% of your budget that you're already upside down that you didn't plan on. And I know that many people know this, maybe some don't. The primary goal for most associations every year during the budget season is what can we delete? They don't want to add things, so the budget doesn't have room to absorb these damages, these unplanned expenses, these water losses. So the associations that don't push those costs down to unit owners are going to suffer more than the ones that do.
Yeah,
unfortunately.
Sure. Yeah.
For everybody.
Yeah. Are you seeing, so kind of leading into trends of, is this something that's happening nationwide then?
It absolutely is. I mean, Florida more so than anywhere. I've reviewed condos in Florida, Maryland, Hawaii, Nevada, Arizona, Oregon, Texas. I'm probably missing a couple, but it's a consistent challenge everywhere. And all insurance is tied to national markets, right? There's not one insurer who only insures Washington State, typically. When the entire nation is dealing with disaster claims, floods, fires, tornadoes, and when Florida has some kind of unusual condo situation, like the Surfside collapse, the spotlight on it and everything goes wonky.
Yeah.
It's not just Washington.
Yeah. So it kind of applies to everywhere.
Maybe something slightly unique about Washington and the insurance market is the ability for associations to sometimes go back and sue former insurance carriers for water damage. So some of these older communities built in the 70s, 80s, 90s, we're seeing them. There's some attorneys who discovered that certain insurance policies said we insure against wind-driven rain damage. Well, by the time we go to do the repair, we didn't know we had wind-driven rain damage. So they're going back and suing all those former insurance carriers that held policies and saying, well, you insured us between 1990 and 1995, so your share of our $5 million repair bill is X, and they're winning. So anytime you go after insurance companies and they pay, they end up charging more to reinsure going forward. So that's a different impact in Washington, maybe than in other states. I know it's prominent and prevalent in Washington. I'm not sure if that's occurring in other states, but I think that's definitely impacting Washington's insurance market, is that many former insurance companies are getting sued for coverage from 10, 20, 30 years ago.
Wow. I didn't know that. So.
And it's significant recovery. It's not like a few million. It's like like 5, 10, 15, 20 million. In fact, 6001, our largest condo out in Redmond in Washington State, 770 units, built in 1972. They've gotten about 20 or $30 million in insurance recovery. Their estimate repair is 70 to 90 million. So better than zero.
Yeah.
The cost to insure is going to go up too.
Yeah. Or do you see that the states and all that you work in, you know, every state has its own kind of legislature as it comes to like the condo formations and all that sort of thing. And I'm sure that you're seeing as you're starting to kind of review all over the nation, how different they are. Is there anything that stands out to you specifically of like, oh my gosh, like this is
I
crazy?
think, yes. Oh my gosh, so many things. I think what is most significant to me that stands out first is Washington State has one of the most robust and specific resale certificate, resale disclosure requirements. Most states have zero. So most states, it's whatever your contract says is what the seller has to provide. Well, in Washington State, even with that robust resale requirement, there's such a divide between the real estate market side and the condominium association management side that in spite of our robust requirement for resale, I've just, out of that 100 I just pulled, there's a 2% compliance rate. So does it make a difference if there's a state requirement for disclosure if nobody follows it? I mean, it's
That's a
better
good
than
point.
no requirement.
Yeah.
So I think that's a big difference between states is that Washington actually stipulates in state law, you have to provide this stuff. At the same time, there's no penalty if you don't really, other than the buyer has the ability to walk away. Other states don't have that same kind of disclosure requirement. What's I think fascinating about that is the states that don't have disclosure requirements often provide all that information for free on a website. You just go get it. It's there.
Gotcha.
And if there's a disclosure requirement like Washington that they get to charge money for, I think that's a huge barrier. The ones that don't have a requirement, you just go get it and you've got the information.
Yeah, that's interesting.
Mhm.
Yeah, because these companies like HomeWise and you know there a few of the other ones that are out there that do all the reporting, and you actually have to pay the fee for. I like it because again, everything comes very uniform. It's not in 20 different emails that you have to kind of go through. It's like okay, everything comes over in one document system. You could kind of go through it, and it does make it a little bit organized. So I do think that you could pay a little to be organized and have all the information that you need.
And
But that is
HomeWise,
pretty,
it
that
is
is
a
pretty
very
interesting.
good delivery system.
Yeah.
That I think is the best mechanism for providing those out there.
Yeah.
The problem with all of those delivery systems like HomeWise or Get Docs Now or whatever the system they choose is it's garbage in, garbage out. Unless the management company puts it into HomeWise, it's not going to come out on the other end if you buy it.
True.
Part of that challenge of updating and managing all of that data for buyers. And
Yeah.
again, if there's no consequence for not doing it, there's not a whole lot of incentive to be great at it or
Yeah.
do it well.
Yeah. And I would say because property managers are the ones that are putting that information together, it's not necessarily the homeowners associations that are managing that aspect. It is the management company on them to know what the legal requirements are of the state, and or not, but have that information all readily available so that the buyers have the information when they're coming in and doing their due diligence.
And that's what buyers expect.
Yep.
So it's like if you're buying a condo, you would expect that the management company can provide the information that's required by state law. Well, 2% of the time I've found that to be true. And it's not always the management company's fault, of course. So they can't force the board to approve meeting minutes. They can't force the board to make decisions about a reserve study and get one. But the management company could put a note in the resale cert that says this association chose not to. There's lots of ways to work around it, but there's so many people involved and engaged with that buyers assume that when you go to buy something, especially if there's a statutory requirement, that it'll be met. And in my experience, it never is. So
Yeah.
then, well, 2% of the time. And I would say aggregate over the 5 or 6 years I've been looking at resale certs, I'd say there's a less than a 5% compliance rate across the board, which is incredibly frustrating for buyers. We want to understand what we're buying. Without that data and without that resale certificate, it's like, asking you to go buy a car and you can't test drive it or take it to a mechanic, but buy it.
Yeah. Yeah. And if you're legally entitled to the information, it should be provided to you.
Mm-hmm.
Yeah. Yeah. Is there anything else that you see trend wise with let's say larger management companies versus smaller management companies that maybe one is better than the other, and I know it depends on the size of the property and everything like
That's
that.
a good question. I think some management companies tend to do better jobs with resale certificates than others, for sure. Even large management companies struggle with those disclosures. So out of the 2% compliance rate, neither of the largest management companies in King County were compliant.
Yep.
And a lot of it's minor. I would say that, to be honest, I think self-managed associations sometimes do a better job with resale certificate disclosures because they follow the MLS resale certificate form. Every management company can have their own proprietary form. And out of the 25 or 30 management companies that represented that 100 sampling that I mentioned, there were 30 different management companies within that 100. And I think out of the 30, 24 had their own system. So there's no consistency and nobody quite does it right. The self-managed ones tend to follow, they pull up the MLS form because they don't have a management company that has their own, and they tend to be the most compliant. And that is kind of fascinating in a way. Professional management companies, I think, play a different role in the governance side or the advisory side to the board. There's just such a disconnect between the association, the board, and what goes in a resale certificate. Like I get the sense that management companies, even the large professional ones, don't talk to their boards about resale certificates. The boards don't know anything about it. They don't even see what goes out or what doesn't or what isn't included. So I think there's a huge disconnect there. And I think the primary disconnect is that associations don't think about buyers and sellers. They think about governance and their community and what's happening today, which is natural, and that makes sense why there's such a disconnect. So I think the management companies could drive a little bit better that disclosure and that resale certificate concept to help boards understand why it's so important.
As far as the compliance factor, what are a couple of the other things that you're seeing, or why are the 2% the major, maybe even smaller issues, but the ones that you see come up quite a bit?
I think that some of the biggest issues are really technical. So for example, the state law says you have to provide the prior year's annual financial statement audited if available. And the management company's response will be the audit isn't available yet. Well, then you provide the financial statement. So I think it's a legal language barrier, just like anything. If you read something legal and technical, you have to read it a few times to get it. There's that angle. So annual financial statement seems to be very confusing for many. I would say that's probably out of the 98% that don't comply, that's probably 50% of them that can't figure out it has to be last year's financial, not 2018 audit, because that's the most recent audit you have. Another big one I'm finding is associations aren't providing the status of any pending litigation, where the association is either a defendant or a plaintiff. Many of these systems have a question. Clearly, the management company can set up a system to have questions and answers. And many of them have the question and the answer: is the association involved in any litigation as a plaintiff? And the answer, no. But there's no question or answer about, are they involved as a defendant? So that's a compliance issue. It doesn't strictly comply. It's kind of minor and technical, but that's one of the things that they can't quite seem to figure out. And then the statute says the status of any pending legal litigation. Recently, I did one, and the status was from March of 2023 was the last notice. So I'm looking at, okay, well, has anything changed in a year? Is the status of any pending and legal, or status of any pending legal action hasn't changed in a year? Maybe you could write a document that says nothing has changed in a year, so no one has to ask. So things like that. A lot of technical, don't quite check the box, but still quite a bit of data missing too. I can't tell you how many times, I'd say out of those 98, probably at least 15 or 20% said we don't have a current reserve study. And then actually they really did. They just didn't,
Yeah.
after you ask and after you read in the meeting minutes that they actually do, then you get the current reserve study. So there's just so many broken layers. I would say the biggest issues are no current reserve study, even though they do have one, lack of financial statements, and just checking all the boxes that the state law requires them to answer. Most of them
Yeah.
don't.
Yeah, I'm smiling because I had a few of those last year where, and actually even bridging over from 2023 to 2024, where they had said, no, we don't have it. We don't have the reserve study, but going in the meeting minutes, we're like, no, you guys did it in November. Like we know you have it. And it took 3 or 4 days to pull it out of them. And then all of a sudden it was like, oh, we found it. It's like, that makes zero sense.
And that's, those are, we don't care, sometimes those issues, yes, we understand, but the reserve study is the one document. If any document a buyer is going to need to understand, it's the reserve study.
Yep.
And now that I've been doing this for a few years, out of that 100, I bet I had at least 10 where they said, here's the reserve study. And I'm like, wait, I have a newer one in my files.
Yeah.
So hold on.
Yeah. What, can you just explain what the Washington State requirement is for reserve studies for those out there that just don't know?
Yes, so Ukiah or Wakiowa, depending on how you want to say it, the Uniform Common Interest Ownership Act we passed in July of 2018. Portions of that statute now override every condominium in Washington state. And one of those is the reserve study requirement. With very few exceptions, every association in Washington state is required to get a reserve study every year. They're required to get an on-site study from a reserve study professional every 3 years and an update in between. So most of those professional reserve company providers will do a 3-year program. We'll come out and do our on-site, and then the next 2 years we'll update it based on whatever you tell us. There still seems to be confusion out there, and I find it more so in the self-managed associations where they're still referring to old statutes, like if it's 10 or 12 units or less, you don't have to. That went away. So
Yep.
new state law overrides that. And on that note, as of February, well, it's on the desk. So if the governor will sign it, if he doesn't sign it, it'll go into effect. Washington state has now passed a new state law that by 2028, every association in Washington state will be subject to Wakiowa. So they're going to start transitioning everybody under the same umbrella for those legal requirements, which will be quite interesting.
So that bridges the next topic then. So would that apply to all these housing projects that are being developed as condominiums?
Absolutely. Yes.
Interesting. That will be quite the burden.
Yes. And kind of what I'm seeing it, I'm not sure quite how to clarify it, identify it, play around, work around it more. But I am seeing under Wakiowa, you could have a property on one side of the street that has 12 townhomes. That's a condominium and is fully subject to Wakiowa. You could have a property across the street that has 10 townhomes that look exactly the same, and they're not subject to Wakiowa. So the land development and land use and creation of these properties is becoming much more technical. And I'm finding that sometimes I'm even struggling to say, well, what is this? How did they create this? Under what requirements?
Yep.
So it's going to change. And I think it will be most impactful for the very small condominiums and small communities being formed, like our ADU or DADU condos, 2, 3, 4, 5, 6 unit properties. It's going to be, just more technical.
Yeah. And I think more lawyers involved, more, I guess, management services, maybe pseudo management services. I think that's I guess, an opening for a new business idea, I guess, to roll in and kind of, help manage those. Because for those of you who don't know, as of late, and I haven't really seen this as much in Arizona as what has been rolling out here in Washington or in Seattle specifically, are properties in the city that basically will be not divided, they're condominiums, they're parcels and converted into condominiums. So you could have the two structures on them, right? A smaller structure and a larger structure, and they're sold as condominiums. And it's that way for developers to really maximize the footprint of a lot, and put two dwellings on one lot specifically. And Rebekah, if you want to explain that differently, step
Perfect.
in, but that's kind of how we view it. And with that, then they're truly condominiums. And so at that point in time, they operate differently than what a normal condominium would be. Even a townhome project, it feels a lot different because it feels like a single family home or two single family homes on one lot. So with that, with them, with the requirements of reserve studies and, all the different things that may apply, it's just going to be very interesting because I don't think those homeowners who originally purchased or signed up for that are really going to grasp onto what their responsibilities are.
I've done quite a few reviews of public offering statements for those 2 or 3 unit DADU condos.
Mm-hmm.
The majority of them, especially if they're two units, I think are golden. Those are really simple as far as clarity of responsibility. Generally, there's a lot that it's cut in half and it's this half, here's your responsibility, here's my unit, here's your unit. And they share a utility line, water sewer line. Ones that get tricky are the 4, 5, 6 unit on one parcel, because there's more relationship to each other. If there's 2 units, then your neighbor doesn't care if you paint it pink and they're not going to sue you. Paint it pink, even if your documents say you can't. 5 or 6, that gets exacerbated. And not that you want to not comply with your documents and paint it pink, but there's not much recourse. There's no impact. There's no, detrimental side to that. Where I think we're going to see a significant impact from this development stage is in 10 years when all of those start reselling. Even though it's a condo and there's only 2 of you and you don't really have to do a budget, because you can get away with not doing anything really, because who cares? That will become important at resale because you still have to provide a resale certificate, even if there's only 2 of you. So if you can't provide a resale certificate, but the other 50 2 or 3 unit DADU those can,
Yeah.
well, then they may buy the other one as opposed to yours if you have no concept how to tell a purchaser what they're buying and comply with state law. So I think the trigger will be the resale certificate requirement, and the ones that resell for value will be the ones that kept some records. The ones that will struggle to sell and retain their value will be the ones that say, we didn't even know we were a condo. What?
Yep.
We don't have anything. And then it's a
Yep.
mystery.
Yeah, and I think that also as an agent stepping into trying to represent something like that, very, very important for them to know what they're going to need to prepare their seller for, proactively or retroactively, in order to get the most as they can based on all the records that the owner does have.
Yeah.
So that'll be a whole new wave of another topic in the future, but a whole new wave of us, representing properties and coaching our clients.
Because just like any condos cannot, there's no condo police, right? If you have 10, 20, 30 unit condo that doesn't follow their documents, who cares? Unless an owner cares enough to sue them to make them. Well, if it's 2 or 3, then it's even more impactful because nobody cares at that level, right? So it's just going to be a different layer of how well do they perform, and not even for the performance sake. It should be centered around resale value.
Yeah, and then because we have a lender on here too, it'll be interesting of how that impacts like the underwriting, right? So a lender gets the documents for a DADU condo situation, and there's no information to provide. There's no financials, no reserve study. So how does that get pushed through, right?
They haven't restated them or whatever the form they fill out to be an association every year. You have to go to the Secretary of State and renew your corporation status, and you have to file a tax return even, So, and I think lending will be a crunch for that, as will insurance. I think insurance is going to drive the condo market in numerous ways, and I think that will also be one of them.
Yep. Interesting. All right. Well, topic for the future for sure.
Yes.
What else? We wanted to kind of touch on new construction. I think your perspective on new construction, Are they less risky? Are they more risky? Like what is the state and what are you seeing right now?
Yeah, we're in an interesting cycle in Washington, I think. We've got a few condos that are moving through their construction defect resolution process under the old state law, under the Condo Act. Insignia and Luma are the two that I'm well aware of.
Yep.
Moving through the process, moving towards resolution, moving through all of those investigations and claims and disputes, and how much do we claim you owe us, developer, for all the problems, and how much money are we going to get? Then we have our new wave of condos built under Wakaiowa that doesn't have the same level of recovery ability under the statute. And this is just an anecdotal example of the difference. So under the Condo Act, there was a lot of technical compliance required with construction. So it's a silly example, but let's just say if the standard installation says you need to nail something every 12 inches and you nailed it every 18, the association gets paid. That's a defect. Under Wakaiowa, you have to prove that that 18-inch variance has caused damage or will cause damage, not just that it was wrong. So the difference in the recovery ability for new construction condos, I think, is going to be significantly different. Which, if we see condos formed under the Condo Act that got a good recovery and had that deferred revenue to pull from several years, one that jumps to mind is Olive 8. Yep. They had a really great settlement. They had that money in the bank for years that they could draw from to make those repairs. I think that's going to be a definite impact on the new construction projects, the Spire, the Nexus, the Emerald, the First Light, all of them coming forward.
Yep.
So I'm interested to see how that plays out. I also know that, of course, and we all see it, newer buildings are much more technical. They're using all of these fancy things, the parking system at Spire, different amenities. Anything that's unique is going to be expensive. So I would project that the cost of ownership for condos formed under Wakaiowa will probably in the long run be 30% more, 40%, I mean, pick a number. It'll be more than condos formed prior to Wakaiowa.
Gotcha.
So then it becomes more of a market increase, right? If every building increases in value at the same rate, then it becomes a math exercise to see, well, which one has the most expenses in the long run? And that's where that reserve study rolls in. It's so critical to say, well, this building has $100 million of expenses in 20 years. This one has 80. And then you can kind of go from there.
Yep. And then that trickles down, translates into the homeowners dues and, all that sort of thing. And, when we look at buildings, I'm a little jaded and have a different perspective because I can look at all the homeowners dues that are in all these buildings with a different perspective of there's a reason why that homeowners dues are high and every building operates differently. But the buyer perspective, I know, and we get it from our buyers all the time, is that, oh, that building has high HOA dues. I don't even want to go look at it, right? And it impacts therefore the values of the building or perceived value of the building itself too. So that'll be an interesting cycle to kind of see where, if this next wave of buildings, they have higher HOAs because of all these different amenities, and you could justify that, that's fine. But there's still going to be the buyers out there that even though maybe they wouldn't use those amenities or, whatever it is, they'll probably put that building on a shelf and not consider it because of them, just their perception of the building.
Absolutely. And I see that a lot with buyers buyers are focused on today, numbers today. And sometimes often, especially with new construction, after going through a review with me, then that perspective totally changes because you have to look at not just today, but are you on a trajectory to be healthy during your term of ownership? I try to focus my reviews. Well, I look at a lot of things, but I really highly focus on the next 10 years. What's happening in 10 years? How will this community function in the next 10 years, which is generally about the term of a condo owner's lifespan. They tend to turn in 7 to 10 years just because that's the nature of condos. So I do have a couple quick examples on that note if you want me to
And I know you've said this before, but generally the sweet spot for condo buildings as far as their age, what is that range again?
I think 8 to 18.
Yep.
When a condo turns 8, generally they've passed through and resolved their 4-year statutory construction defect timeline by year 8. I think with COVID now, we're working on maybe 8 to 10 years for some of these to kind of get through all that. But once the community goes through construction defect litigation, gets money, fixes problems, then they're stable. So you have that stabilization period of about 10 years before you have to deal with usually your first renewal, which is usually the roof, which is usually very expensive. So by the time a building turns 18-ish, it's like, oh, well, we're behind. Another reason they're consistently behind by the time you get to the first major renewal is the developer starts out contributing about 9 or 10% of the budget to reserves. That's about the ratio. Insignia is up to contributing, and this was a recent change. By the time a building turns 8 or 10, they typically have to increase their budget by 30%. So Insignia is now contributing 17% of their budget to reserves. They started out at 9. And that one factor that's translated in the 5 years, their budget, their annual assessments have gone up 39.5% since the time they were established. So there's that cycle of, while the developer's in control and they're controlling costs, it stayed low. Once the association takes over, and now we want more janitors, and now we live here and we see that we need things, and that fee broke because no one used it yet. So it takes a while for a building to stabilize, and I think by about the year 8 to 10, they're pretty stable, and from there you should see pretty regular, standard, solid performance is what I see. So I had a couple quick examples about reserve studies. This one was a recent review I did. This reserve study was produced in 2023 for the year 2024, and all reserve studies are typically issued the year before they contemplate. So the purpose is we tell you, here's how much you should put aside next year in your budget based on what we see. So this reserve study assumed they had a starting reserve balance of $615,000 at the time it was issued. At the end of the year, they actually had $680,000 in their reserve account. They also assumed they would be contributing $357,000 to the reserve in 2024. The association chose to budget $373,000, which is way more than what they recommended. The full funding recommendation in the study was $364,000, which this association was funding well above. And what that meant was the buyer looked at this and said they look like they're in trouble because the reserve study assumed these parameters. Well, when I plugged these real numbers into my charts, it's like, well, look, they're really not that bad. And the difference between what the reserve study said, your deficit, if you contribute $27 a month more for your unit, then you would have no deficit. So the buyer was able to say, okay, well, that's not that big a deal because you could, I was able to kind of drill it down. And this is a consistent challenge with reserve studies. They're produced at a point in time. And it may not be true by the next time or at the annual or even the next day. Here's another good one. This reserve study said they were 108.6% funded, which you and I know is bonkers. I mean, I think 5% of associations in Washington state are at or near fully funded, and a lot of those are in the middle of a special assessment to stay that way. It's not a good measure. But here's another example of, by the time we actually looked at the true data, they assumed a starting reserve account of $825,301. At the end of the year, they actually had $644,000. So instead of truly being 108.6% funded, they were actually 84.76% funded. And this is an example of where sometimes this could be really impactful to a buyer if we went from 30 to 10. In this scenario, they're incredibly healthy, so it didn't really matter. It's like, look at that chart. They're not going anywhere near going underwater. So they're just clearly a very responsible association. And it's okay that they were lower in their actual dollar amount because it didn't impact their projections. Here's an example of one I did recently. And this was explaining to the buyer, why are they so far behind? Why are they looking at this major special assessment? And this chart is one of the ones I use when I do my reviews. And this chart shows their history of what did the reserve study recommend, which are the blue bars. The yellow line is what did the association actually budget. So if the association is budgeting 70% below the minimum recommendation, that explains why you're looking at a massive special assessment. I think that the visual data really helps illustrate those concepts. And what I consistently see is that buyers and brokers don't fully understand that the reserve study is a point in time document. They get it, if we get it in November and it was produced November of last year, it's the truth. Well, it's not. You have to factor in those other, where are they today? And those data points aren't living data points.
Yep. Are you seeing, I know that we are very much more proactive in getting our reserve studies here in Washington, but are you seeing that those are being done in other states as well?
They are, just not as consistently. So yes, I definitely see them. I don't believe they're as regular, which may not be a terrible thing. For example, if we were in our 08 to pre-COVID normal 3 to 5% increase, well, if costs are about the same and nothing's changing, well, you don't need to maybe get one next year if you didn't do anything and there's nothing going on. Now, with our current inflation and with all of the backup work that wasn't done during COVID, if they're not doing one every year, then you have no idea what you're buying. So I see it too. It varies, definitely variable between state. I think Washington, of course, having a robust reserve study requirement helps. Not that it follows it, but it definitely helps to get those consistent. I think Hawaii is really good at it. They do regular studies. They're a little bit more, they also have an annual reporting requirement with the state. So they're a little more technical, regulated, structured. But other states, it's like, we get one every now and then.
Yeah.
Maybe.
And with, let's say Arizona or more of the sprawling communities versus the vertical communities, do you see any differences in maybe what their, the reserve allocations go towards? Or, because I know, like you said, roof is always a thing. Elevators in the high rises are always a thing. But is there anything else that you see with those other communities and other places that are worth noting?
I'm always shocked by asphalt paving. At how often they defer the seal coating. Then when it's time to actually do the repairs, it's massive. So those master plan communities, the large communities, definitely they're very different, of course, because they're not dealing with structural expenses. They just have to paint the cabana, or they don't care about water intrusion with the tower because there aren't any. Individual owners manage their own structure. I'm always shocked by the cost of asphalt and paving, how expensive it is, and how skipping the seal coat, which they tell you, do this every X number of years, and then when it comes time to do the real work, here's how much it'll cost. Well, they skip those other preventatives, and then by the time they get to it, it's 4 times as much, and they have to do a special assessment, and everybody loses their mind. So asphalt, I think, is one of the big ones, definitely. Another sneaky one is most associations budget for landscaping, and they budget for regular landscaping, not as much in the reserves. It's always more of an operating expense. So when it comes time to swap out systems or deal with a problem, very few associations put any type of contingency in their reserve study. So I would love to start seeing master plan communities put more of a landscaping contingency, because something's going to break that we don't plan on, and then you don't have it in your budget because you didn't plan on it. But I would say the big one for master planned large communities is asphalt.
Interesting. I wouldn't have thought, well, now I would think that, but very interesting. And insurance is the same, treated the same for those type of communities as well.
Yeah, it's not quite it's not exacerbated in the same way, because they just pretty much, they carry liability for common areas, but they're not insuring structures the same way.
Gotcha.
The burden of master planned insurance is more for the liability and for, if somebody trips and falls and we get sued, and then insuring, any amenity spaces. Because then individual owners insure their own unit, which is typically the structure and everything inside. But yeah, it's going up too, just not the same way, and that's not contributing to master planned increases the same way as verticals.
Mm-hmm.
The increase for master plan is purely inflation. The cost to pave is now 30% more than it was 2 years ago.
Yep. And we also had strikes during that time too.
Mm-hmm.
So you have the
Yes.
labor aspect of that as well.
Yeah, and you can only do it during certain times of the year in certain states.
Yep.
And if there's only a few providers left after COVID, well, now they're charging a premium. And I feel like that's starting to level out a little bit.
Mm-hmm.
A year or two after COVID, you couldn't find providers because nobody was around, nobody was in business anymore, and those associations got further behind. So I think post-COVID, it's starting to level back out a little bit, but insurance is still the wild card. Not quite as impactful for those master plan. Inflation is the most impactful for those, but insurance for sure for anything attached.
Yeah. Well, I think we kind of hit what we wanted to. Is there anything else that you want to share? Any stories or?
Oh, so many stories, Ashley.
I know.
I would say for buyers, with so many buyers being first home buyers, I think their perception of condos is really skewed as so much of our condo infrastructure ages. So we're in an environment where, the significant portion of at least the West Coast was developed in the 80s, 70s, 80s, 60s, 70s, 80s. And the perception of condos isn't necessarily the same in their minds that I'm buying a house built in the 70s, right? They think it's a condo, it's new, it's different. Well, they're all, the structural issues and the time of construction is really impactful. So I think for buyers, if I was to advise a buyer, I would probably start with some form of concept around age of construction as the number one factor for consideration. When was the structure built? And then from there, you can start to extrapolate costs. So I think that's kind of where I've landed with, if I were to advise a buyer about one thing related to condos, I would start with age of construction, and the reserve study goes hand in hand with that. After that, there's so many variables, but I think that's the most impactful related to cost for a buyer is when was it built?
Sweet. Well, great advice. And it's up to us also as agents to kind of identify those things as well. But you've always been an amazing resource, and I love having you kind of to be able to go through these things in a lot more detail. I learn something every time you do a review for a buyer of ours. And I do think that also the knowledge you have is very impactful and should be a resource for the homeowners associations too, the boards who know nothing. The board president who just got elected, who, literally doesn't really know much about condos, hasn't owned one before. And, there needs to be more coaching and guidance, or seeking for the coaching and guidance in order to keep up values for the buildings, the properties, and what have you. So anyhow,
for more education.
Education. Yes. Well, thank you. Thank you everyone for joining today. Reach out to Rebekah if you have any questions, or myself. And then we'll look forward to doing another update about condos maybe in a few months here, just to kind of touch base maybe on the seller side or whatnot, or if you guys have any topics you want us to specifically address, let us know. So
thanks for having me, Ashley.
You bet.
Pleasure.
Yep. Chat with you soon. Thank you.
Bye.
Bye.